Imagine waking up, grabbing your phone, checking your portfolio, and seeing years of hard-earned gains just seemingly vanish in real time. Well, for millions of investors in June of 2026, that wasn't a nightmare, that was a very real Tuesday. A massive fear of an AI stock bubble triggered a highly aggressive global sell-off in literally a single trading session, wiping out billions of dollars before most of us even had lunch. Welcome back to Zak Wealth Files. I'm Zak, and my entire mission here is to make investing and wealth building simple, accurate, and genuinely useful for you. Today, we're diving into an explainer to demystify this current AI market panic, and we are going to do it by looking strictly at the hard numbers.
To really grasp the scale of the fear out there, we have to look at what actually went down during that massive June 2026 sell-off. Because guys, this drop wasn't just a slight dip or a regular bad day at the office. Over in South Korea, their stock exchange fell so fast and so violently that it actually triggered a circuit breaker. And if you're not familiar with that term, a circuit breaker isn't just some technical glitch on a screen. It means the panic was so severe that the exchange literally had to step in, pull the plug, and completely halt all trading just to stop the market from free-falling. They ended the day down a staggering 10%.
Meanwhile, here in the US, the tech-heavy Nasdaq took a brutal 2% nosedive in a single session. We're talking major players anchoring the AI boom. Giants like Nvidia, Micron, SK Hynix, they all took a very sharp hit. But you know, this didn't just come out of nowhere. In the weeks leading up to this, some of the most respected hedge fund founders in the world were already ringing the alarm bells. One prominent billionaire actually came out and publicly stated that this current AI boom is roughly 80% of the way to the absolute euphoria we saw it right before the devastating 1929 crash or the 2000 dot-com bust. And look, when people who manage billions of dollars start tossing around 1929 comparisons, the market listens.
So that brings us to the multi-trillion-dollar question, right? Is this 1999 all over again? In this explainer, we're going to cut straight through the panic. We'll look objectively at the numbers on both sides of the debate. We're going to reveal a hidden portfolio risk that almost nobody is talking about right now, and I'll leave you with a clear, step-by-step action plan you can use this week to protect and grow your wealth.
We have to start by validating these market fears, because the data driving this bear case is very real. Take a look at the sheer scale of market concentration right now. Think of the stock market like a giant game of tug-of-war. Today, just 10 giant stocks are pulling with the strength of 35% of the entire S&P 500 index. The other 490 companies, they make up the remaining 65%. So why is that dangerous? Well, if just 2 or 3 of these massive tech giants report bad earnings, they have enough gravity to drag down the entire stock market, taking your retirement accounts right down with them. To put that into perspective for you, at the absolute peak of the dot-com bubble in 2000, the top 10 stocks only made up about 25% of the index. Today's concentration is historically massive.
Then, we have to talk about valuation metrics, specifically something called the Shiller PE ratio. If you haven't heard of this, it's essentially a long-term valuation measure that adjusts for inflation and smooths out short-term crazy earnings swings. It gives us a much more reliable picture of how expensive stocks are overall. Well, recently, that number crossed 40. Now, over a century of market history, we're talking through world wars, recessions, global pandemics, this metric has only breached the 40 mark exactly one other time. Yep, right before the dot-com crash. Furthermore, there's this very measurable, glaring gap between what companies are spending on AI and what AI is actually earning them back. Current estimates show a massive $400 billion pouring into AI infrastructure. That's companies buying up chips, building massive data centers, the whole shebang. But the businesses actually trying to sell AI software to customers, that revenue is estimated closer to just $100 billion. That is a $300 billion gap between the money going in and the money coming out. It basically means a lot of companies are throwing billions at a technology they haven't quite figured out how to monetize yet. In fact, a widely cited MIT study found that the large majority of generative AI pilot programs at these companies haven't even turned a profit.
And honestly, perhaps the most sobering signal comes from inside the house. The CEO of OpenAI has publicly stated that investors may be, quote, overexcited about AI. It is one thing for a grumpy Wall Street bear to call it a bubble, but when the people selling the pickaxes in the gold rush are telling you to calm down, it's probably time to pay attention. Having central figures acknowledge the risk adds a massive layer of credibility to this whole bubble debate.
Before we declare that the sky's falling, we absolutely have to look at the objective bull case, because this current AI rally has very different financial underpinnings than past crashes. The contrast is actually stark.
Back in 1999, people were buying stock in companies whose only real asset was a cool website address and maybe a sock puppet mascot. They were wildly speculative bets. Today's AI leaders are structurally different. Look at Nvidia. They aren't just selling a story, they're generating staggering, very real profits, reporting net margins around 53%. To put that in perspective, a highly successful traditional business might be absolutely thrilled to hit a 10% margin. These AI companies are essentially printing cash, and that is a fundamentally different financial reality than the profitless pets.coms of the year 2000.
Another huge indicator is the bond market. Specifically, we look at high-yield credit spreads, which is just a fancy way of measuring the difference in yield between riskier tech bonds and super-safe government treasuries. Now, in the financial world, bond investors are notoriously the most paranoid people in the room. They sniff out risk before anybody else. Usually when a severe crash is truly imminent, these bond investors panic and these spreads skyrocket. But as of mid-2026, credit markets remain totally stable and these spreads are relatively low. The bond market just isn't flashing the red warning lights we typically see before a massive credit-driven crash. The smart money isn't panicking.
Finally, it's worth noting that before that June pullback, the Nasdaq actually posted its strongest second quarter since the 2020 pandemic rebound. That points to genuine underlying business momentum. And right now, highly sophisticated investment banks are looking at the exact same data we just talked about, and they are coming to totally divergent conclusions. Some see a massive bubble, others maintain incredibly bullish year-end targets. If armies of Wall Street analysts with supercomputers and decades of experience can't agree on whether it's a bubble or a bull market, it proves one thing for sure: trying to time the absolute top yourself is a fool's errand.
This is the part that directly impacts everyday passive retail investors who think they're playing it entirely safe. Millions of people pat themselves on the back for being perfectly diversified by simply holding a boring, low-cost S&P 500 index fund. You might think, hey, I'm immune to an AI crash. But here is the catch. Because the index is market cap weighted, meaning the biggest companies literally take up the most space, a massive chunk of every single dollar you invest is being funneled directly into just 7 AI and tech giants. Because of that concentration we talked about earlier, a third of the entire S&P 500 is tied up in the Magnificent Seven. So your quote-unquote diversified fund is actually highly concentrated. You have a front-row seat on the AI roller coaster, whether you deliberately bought a ticket or not.
Let's actually do something about this. Step 1. Look under the hood. You need to know your real exposure to these tech megacaps. It's super easy. Just look up your mutual fund or ETF's ticker symbol on a site like Yahoo Finance, click on Holdings, and see exactly how much of your money is sitting in the top 10 tech companies. Step 2. Resist the urge to make dramatic overnight changes to your portfolio just because of a volatile trading day. Remember, that June sell-off partially reversed within days. Emotional selling during a dip only accomplishes one thing: locking in your losses permanently. Step 3. If you look under the hood and you are genuinely uncomfortable with your concentration risk, consider broadening your diversification. Now, this doesn't mean selling everything you own. It might just mean directing your future contributions into something like an equal-weight S&P 500 fund or maybe small-cap value funds that fit your personal goals. Step 4. Separate the technology from the stock. The internet absolutely changed the world, but if you bought Cisco stock at its absolute peak in 2000, it literally took decades just to break even. AI is undeniably transformative, but great technology doesn't always equal a great stock price at this exact second. And finally, step 5, resist buying into the hype. Stick to disciplined automated investing. Please don't add a massive chunk to a position just because it's getting intense media attention or your neighbor won't stop talking about it. Chasing hype is exactly how risk gets heavily concentrated right before a major correction.
Now, an honest but absolutely crucial caveat. Markets carry real risk, and absolutely no one has a crystal ball. This explainer is strictly general education based on July 2026 data. This is not personalized investment advice. Your financial situation is entirely unique to you, and any major moves with your life savings should always go through a licensed advisor who actually understands your specific goals, your time horizon, and your personal risk tolerance.
Ultimately, understanding your own exposure always beats trying to predict the future. Whether this AI boom is a massive bubble just waiting to burst, or a completely justified financial rally, well, that's an open question. But knowing exactly what is inside your own portfolio, that is something you have total control over today. If you found this breakdown clear, honest, and genuinely useful, make sure to subscribe to Zak Wealth Files. And hey, I really want to hear from you in the comments. Based on the hard numbers we just walked through, do you think we're in a genuine bubble, or is this a fundamentally justified rally? Let me know down below, keep building that wealth, and I'll see you in the next explainer.